Hello, and welcome to Money Mystery No More. Do you know how to apply a percentage for the most common day-to-day uses, like sales, discounts, including coupons, tipping the server, or what about more infrequent uses such as time for your job bonus or annual performance increase, or when shopping for an auto loan rate and so forth? Do you know how to calculate the rates and fees associated with the related percentage? Fear not if your answer is not overly confident. Let's talk about the concept of simple interest, because it is, interestingly, simple and beneficial once you go through it and understand the basics. It can be fun too. If you want to really benefit and get the most out of this video, listen closely and take notes as we go through real examples of everyday practical applications of simple interest to help you with daily uses by keeping it simple. It's awesome. And remember, hit that subscribe button to keep getting the latest and greatest information. Okay, let's remove the mystery. Maybe you are watching this video because you would like to be more familiar and more comfortable with the basic use of the percentage and how it impacts you. A percentage is commonly known as a rate, an interest rate. Interest is extremely common among businesses as a fee charged to you on top of the principal amount for the use of their assets. Normally when you borrow something from them. This typically involves the money you borrow from them for a good or service you want or need. But wait, the good news is that it works the other way too. You can be paid interest for loaning your money to a borrower, sort of like you're charging them interest. When involved in transactions of this type, you will often read about or hear the term interest rate or even APR, the annual percentage rate, during your talk, negotiation, or discussion. Your objective is understanding how it works for you or how it works against you so you make the best decision for your situation at that given time. Simple interest is basically a fee that borrowers pay to a lender for a loan over the life of that loan. That fee is typically expressed as an interest rate. It is an interest charge calculated using the principal amount only. And that principal amount is just the amount you start with, the balance. It's often the starting amount of a loan or even investment. So the interest rate is applied to that principal amount to calculate the interest fee. Simple interest just multiplies the interest rate by the principal amount and factors the term of the loan, also known as the length of the loan. Calculating simple interest is easy. Just multiply the principal amount of the loan by the interest rate in annual terms and multiply that by the term of the loan in years. The simple interest formula is represented as P times R times N, where P equals principal, R equals interest rate, N or T equals the term of loan in years. As you can see, you calculate simple interest by multiplying the original loan amount, the principal, by the interest rate. Then you multiply that by the term of the loan in years. Note that some recognize the term as N or as T in their formula calculation. For a down low, quick and dirty calculation, assume you borrow $100 from your coworker and they say it will cost you 10%. Well, that 10% is the simple interest rate. So it would be 100 times 0.10 for a simple interest rate of $10. Therefore, you will pay your coworker the principal $100 plus the simple interest fee of $10 for a total payback of $110. In this case, you might have seen that it was a flat 10% fee. That's because simple interest does not compound, which in this case works for you. Compounding involves time and the adding on of the balance due over time. So simple interest is a basic formula to provide you, the borrower, a quick idea of what it's going to cost you to borrow money. Simple interest is a big benefit versus compounding interest because it's generally going to cost you less in the long run. Now, on the good side, remember that you, as the lender, assuming you open a savings account or some other high-yield account, also get a quick idea of what it's going to reward you to loan the bank, the borrower, your money. Cool, right? Pretty straightforward. This type of interest, simple interest, usually applies to automobile loans or short-term loans, although home mortgages also use this calculation method. There is an additional factor you want to keep in mind as you look at borrowing whenever interest is involved, and that little factor turns out to be a big factor, your credit score. Most often, the interest rate applied to your loan will be based heavily on whether you are considered low risk or high risk. Real simple, you will be able to negotiate a lower interest rate if you are low risk. If you have a strong, good credit score, you are considered low risk typically, but you won't have a ton of wiggle room if you have bad credit and are deemed high risk. If you want or need some assistance in this area, listen to the Money Mystery No More video, Correcting Your Credit Score, to strengthen your credit position for better rates and negotiation posture. On we go. As previously mentioned, your objective is to understand how interest rates work for you or how it works against you. With simple interest, there are good uses of interest rates and there are consequences of interest rates, though they may be unavoidable. Think of the two most common scenarios. A. Good use. Bank accounts provide you an interest rate on the monies you deposit with them. The interest rate works for you because it is a fee paid to you by the bank because you are letting them use your money. Savings accounts pay you with simple interest in many cases. Even though the earnings are nominal, it's better than nothing to keep your money safe and FDIC insured. You may also seek compounding interest accounts and a high yield account that offer a higher interest rate. Either way, simple interest is working in your favor. Now think of the second, B, bad use. Banks also provide you an interest rate when you finance a vehicle from them, whether it's used or new. This interest rate works against you because it is a fee you pay them to borrow the vehicle until you have paid them the full amount of money owed. Most vehicle loans run 5 to 7 years, and that interest rate is a fee you pay for borrowing the bank's money during that time. This is unavoidable unless you are able to pay cash up front for that vehicle. Realize that many loans, including mortgages, use simple interest. But there are also loans applying compound interest, which will really be bad for you. With compounding interest, the interest rate factors the principal amount and the ongoing accumulated interest based on how often it applies, such as daily, weekly, monthly, or annually. The interest fee accrues and is added to the principal prior to the payment being applied. Obviously, this type of interest will cost you more than simple interest. Depending on your situation, financially, you likely want to avoid these types of loans if able. Let's get into another subject impacting simple interest as well as compound interest. Introducing APR and APY. APR is annual percentage rate. APY is annual percentage yield. Most consumer loans involve interest rates quoted as an APR. Basically, this is the rate of return, the fee charged, that your lender will require for borrowing their money. You need to be aware that the APR does not factor compounding of their interest rate, so this is normally the simple interest rate. Your amount of interest never changes with the interest rate being set and applied to the original principal. Just make your payments on time and it's easy peasy. This is good because you know the amount involved with every payment. It's simple interest. Then you get the APY. Basically, this is the rate of return, the fee charged, that your lender will require for borrowing their money, compounded for the year, normally onto each payment. You need to be aware that the API will add more cost than simple interest because the balance is factored on every payment. The interest rate is multiplied into the balance and length of loan for each payment. Ultimately, you pay more with compounding interest due to this. However, on the flip side, when you are earning money from a high-yield account or other instrument, this is great news because the institution pays you interest on the current balance each applicable period. Just like when you pay them for borrowing, they pay you the same way. Hopefully your balance is growing each week or each month because you are adding to it. So in this case, as an investor, you definitely want to take advantage of compounding interest. You see, lending institutions often use simple interest, especially on short-term loans like those under a year. Yet they often use compounding interest too, depending on the amount involved and the time or length of the loan involved. The lender may require daily, monthly, quarterly, or annual interest payments. And that also holds true for you when you collect interest from the lender, bank, bond, or other instruments. You may be paid interest daily, monthly, quarterly, or annually. It all depends on the lender, the amount involved, and the time. You just need to be smart when you are involved as the lender or the borrower and how the simple interest or how that compounding interest will impact you. Simple interest is interestingly simple when you consider these key takeaways. First, the calculation for simple interest is fairly easy and straightforward, P times R times N. 2. You as a borrower can save more money with simple interest. 3. A debt can be paid off quicker and be easier to manage the numbers. 4. The interest fee is never applied to the principal amount, resulting in a higher balance. It's not compounded, so you never end up paying interest on top of interest. Compounding interest also has its key takeaways for you to consider. 1. The calculation for compounding interest is still easy but not as straightforward, and does require a financial calculator to get the exponential factor, or do it the old-fashioned way period by period. 2. You as an investor can save more money with compounding interest. 3. A debt will likely take longer to pay off, and because of compounding, it is trickier to manage the numbers. 4. The interest fee is always applied to the principal amount, which results in a higher balance each pay period. It is compounded, and you end up paying interest on interest. Let's look at a comparison of the two using simple interest versus compound interest. To show the math involved each period, we will go old school and calculate the interest each period and then the end of year balance so you can see it year by year. Okay, a side-by-side comparison of simple interest versus compound interest. Look at the common factors used. principal or opening balance is $4,750. The interest rate is 5%. The term or life of the loan in years is 5. The formula for each is different, but they yield a difference interest to be paid. Simple interest results in $1,187.50 in interest. Compound interest results in $1,312.34 in interest, which is $124.84 more. The total paid after factoring interest under each method is: simple interest method totals $5,937.50 at the end of 5 years. Compound interest method totals $6,062.34 at the end of 5 years. The main takeaway in this example is both methods are effective for you as either a borrower to pay debt or as an investor to earn. Depending on your situation financially, you will be able to embrace the method best suited for your needs. At this point, you understand that as a borrower, you want simple interest, but as an investor, you definitely want compound interest because it's a step in building your wealth. Regardless, there will most probably be a time in your life when you will need to use simple interest, and now you know it is interestingly simple. Just remember the basics and know you can figure out how best to apply it by keeping it simple. Remember, hit that subscribe button and turn on notifications so you keep getting the latest and greatest information from Money Mystery No More. I'll see you in the next video.